Hey everyone, welcome back to Corporate Decoder, the place where we untangle the big corporations and reveal their secrets before they even know what hit them. Today we are diving into DigitalBridge Group Incorporated, or DBRG as you might know them on the stock market. And let me tell you, this quarterly report is a roller coaster of shifts and turns, especially when we look at how they are making and spending their money. Let's get straight to the most juicy part, the numbers that tell the real story. First up, we see their assets. They've got over $3.4 billion in total assets, which sounds like a lot, and it is, but when you compare it to last year, it is actually a slight dip. Not a huge one, but enough to notice, especially when you look at their investments, which are down by around $30 million. That is not a small change in the investment world. Now, let's talk about debt. Companies always have debt. It's how they fuel big projects. DBRG's debt increased from about $296 million to over $327 million. That is an increase of roughly $31 million. While not alarming on its own, it is something to keep an eye on, especially as interest rates can make carrying more debt more expensive. Here is where it gets really interesting. For the 9 months ending in September 2025, they reported a net loss of over $53 million. Now that sounds bad, but last year for the same period, they had a net income of almost $147 million. That's a massive swing, a drop of over $200 million. This significant change is mostly because of how they account for something called carried interest. In 2024, they had a big positive number, but in 2025, it is showing up as a negative. Think of carried interest as a bonus they get when their investments do really well. When the market is tough or their investments haven't performed as expected, that bonus can disappear or even become a reversal. This explains a huge piece of that financial puzzle, but it is not all bad news, far from it. Their fee revenue, the money they actually earn from managing their clients' investments on a regular basis, that's looking strong. It increased by about $17 million for the quarter compared to last year, and overall for the year, it is up by over $40 million. That is an 18% jump for the year, showing that the core business of managing money is growing. They attribute this mostly to new money being put into their main investment funds, and also some smart co-investments. Now, about that carried interest we mentioned earlier, for the 9 months ending the 30th of September 2025, it's a negative $290 million. Compare that to the same time in 2024 when it was a positive $263 million. That is a swing of more than $500 million. This huge difference is creating some wild swings in their total reported revenues. Remember, this isn't necessarily cash they lost, but an accounting adjustment based on how well some of their longer-term investments are performing and expected to perform. On the flip side of that carried interest roller coaster, we have their principal investment income. It's up significantly. For the 9 months ending September 2025, it is over $51 million, a jump of more than $22 million from last year. This income comes from when they actually sell an investment or receive profits from it. So it is more tied to real transactions happening. They had a big win with a databank investment this year, which brought in about $34 million in income distribution, even though they also had a substantial loss from another portfolio company. Let us talk about the people who make the magic happen. Compensation costs are up. For the 3 months ending the 30th of September 2025, they spent about $49 million on compensation. That is an increase of nearly $6 million from last year. For the 9-month period, it is almost $142 million, which is down slightly from last year. This increase in cash compensation is mainly due to higher performance bonuses, which makes sense if the company's core fee generating business is growing. Good news on the cost side, administrative expenses are down substantially. For the 9 months ending September 2025, these costs are around $42 million, a drop of over $35 million compared to last year. They're seeing significant insurance recoveries this year, which help to offset past litigation costs, and they're also spending less on outside professional services. Now let's look at what truly matters for the company's ongoing operations and its ability to pay dividends or reinvest in itself. They use a measure called distributable earnings, or D. This is a non-GAAP measure, meaning it's their own calculation that aims to show the real operating performance, excluding things like stock, base compensation, or losses from investments that have not yet been sold. For the quarter, Delaware is up to about $21.7 million, a jump from about $10.7 million last year. That's a great sign, close to doubling their distributable earnings. This is driven by that growing fee revenue we talked about. Their fee-related earnings or FRE is also looking sharp. It's up to $37.3 million this quarter, a nice 43% increase from last year. This metric focuses on the recurring revenue from fees minus operational costs, giving a clear picture of the health of their core ongoing business. This growth is fueled by that increased fee revenue from new capital and successful investment strategies. Here is a really important metric for any investment manager: assets under management, or AUM. It is the grand total of money they manage across all their funds. It's up to over $107 billion, a significant increase of about $12 billion from the end of last year. Their fee earning equity under management, or FEEM, which is the portion of that arm that actually makes them money through fees, has also grown to over $40 billion. This shows they are successfully attracting more capital and putting it to work. Looking at their actual fund performance, it is a mixed bag, which is pretty typical for this industry. Some funds like DBPI are showing solid returns with a net multiple of invested capital of 1.4 times and an internal rate of return, or EIR, of 8.7%. Others like DBP2 and GIFI-C are showing lower multiples or even negative IRRs. This highlights the high risk and high reward nature of their business. They are making big bets with investor money. On the leadership front, there was a recent change. Ian Shapiro stepped down from the board in October, but they quickly appointed Jay Wintrob as a new independent director. Mr. Wintrob has a very impressive background, having been CEO of Oaktree Capital Group and holding senior roles at AIG Life and Retirement. His expertise in finance and leadership will likely be very valuable to DBRG as they navigate the complexities of the market. So, what is my take on all of this? DigitalBridge Group is clearly navigating a complex financial landscape. They are experiencing significant swings in their reported income due to accounting for carried interest, which is normal in this business but can make month-to-month earnings look wild. However, the underlying fee-generating business is healthy and growing, indicated by the rise in fee revenue and fee-earning equity under management. Their core operations, shown by the strong growth in fee-related earnings and distributable earnings, look very promising and are likely more indicative of their true operational strength than the big swings in their bottom-line income. The risks, as highlighted, are always there. Market downturns, interest rate hikes, and the inherent volatility of investment performance can impact everything. But they are also bringing in strong leadership and growing their core revenue streams. In conclusion, DBRG is a company that swings for the fences, and while that can lead to big gains, it also means big potential for accounting volatility. Focus on those recurring fees and distributable earnings. That is where the real story of their ongoing success lies. What do you guys think about DigitalBridge Group's latest performance? Let me know in the comments below if you found this deep dive valuable. Make sure to smash that like button and subscribe for more corporate breakdowns. And hey, join our Discord community linked in the description for even more unfiltered financial talk. Thanks for watching. This has been Corporate Decoder. See you next time.